I got to attend the Berkshire Hathaway annual meeting this year and wanted to take some time to go over the highlights from the Q&A session that Warren and Charlie did, and as they do every single year. So just wanted to kind of go over my notes here that I took while I was at the meeting. And I guess starting from the top, they talked a lot about float towards the beginning of the Q&A session. Float being the money they kind of have set aside for insurance, and they call it better than debt, better than equity, and it's an asset that shows up on the liability side in that they can reinvest this float into things. And obviously in Berkshire's history, they've used that to great effect and have been able to reinvest that money and compound it in a magnificent way. So, but just interesting that they call it better than equity and better than debt, because unlike other debts, it's not necessarily, well, I guess it is technically callable if you have a bunch of insurance claims, but if you're responsible with it and you manage the risk right, it's not as though you have like a payments to make every single month. It's interest free, and it's also better than equity because you're not actually giving up a share of the business. You're maintaining full control of all the gains from that float. So interesting that they kind of characterize it like that, but it does make a lot of sense. However, you got to tread carefully with that. If you're an insurance company and you burn that float because you invest it poorly, then you're going to be in some big trouble if you do get a casualty event and you have to pay out a bunch of claims. But just interesting that they kind of talked about that. And speaking of capital allocation, they mentioned that the dividend that they issued back in 1967 was a, quote, terrible mistake. Just funny that they were reminiscing on the horror of giving out a dividend. Berkshire has basically never given a dividend since 1967, and they instead will reinvest their money into more businesses, or they will occasionally do buybacks of their stock when they think it trades cheaply. And they talked about that later in the meeting as well, and how when it comes to that sort of returning money to shareholder idea, they would always prefer to buy businesses. Warren Buffett was talking about this for quite a bit. He said, the best thing that we can do and what we're always trying to do is buying great businesses. But as he also kind of complained about, sort of a complaint, I guess, in the meeting was how it's very difficult to find those great opportunities just given the scale of Berkshire's cash pool and given the scale of their operations. They really need some big opportunities to move the needle, and those are harder to come by. So that's always their preference, is to find great businesses to invest in or reinvest in, but that's not always the case. So if Berkshire is cheap, that's another business they could technically invest in, so they can buy back their own stock. And that's what they prefer to do. They don't like doing dividends. They would rather reinvest and bet on themselves as capital allocators, or at the very least, just trying to give everyone a greater share of the underlying Berkshire business via buybacks. So funny note on the dividend there. A terrible mistake, says Warren Buffett. And then they were asked about making decisions on emotions. And I think the question was like, has Berkshire ever made an emotional decision and have they regretted things or something like that? And the quote I wrote down here from Warren Buffett, it says, "I can't recall in the history of Berkshire making an investment on an emotional decision." And we'll take his word for it. It's hard to prove, but it would make sense given the track record that they tend to be pretty logical, I would think, and I don't want to say stoic, but they tend to really just try and look at the facts and make the decision for the long run. And if they get new information, they're not afraid to sell either. But it never feels like an emotional sort of swing trade or trying to pile in because they fear something. A lot of times they're going into very you might call them boring businesses. So it wouldn't really make a lot of sense that they'd be making emotional decisions if they are investing in the very boring, standard, I don't know what other adjectives to use, but those kind of businesses, not the hype stocks. Typically, they're not really going for that sort of thing. But interesting that he said it with great confidence that they've never made an emotional decision. Would make sense given their success, because if they were making emotional decisions, you wouldn't expect the same level of success that they've had. And I wonder if maybe they've gotten even less emotional as time has gone on and as they kind of see the bigger picture and just continue to be reaffirmed in their views on how to invest and how they're investing. Now, kind of a pivot from there, someone asked about AI. There was a few questions about AI during the Q&A, and I'm sure this will get a lot of headlines. I'm recording this on the Monday morning before I head out from Omaha. It's my last day here, so I'm not sure if the news has already covered this, but I'm sure this will be a headline. Charlie Munger was saying about AI that I think old-fashioned intelligence is just fine. He's kind of writing it off a little bit when talking about AI after he kind of mentioned that BYD uses a bunch of robotics in their plants. And I'm not sure if that's what people are really getting at when they're talking about AI, but fair point. But he seemed to kind of lessen the hype on AI, I suppose is the best way to put it. And right alongside that, Warren Buffett said, we won't be able to uninvent AI if it comes out. And he compared it to the atomic bomb and how it's just one of those things that it just kind of happens. You feel like you need it at the time. You could argue, even in hindsight, that it was the correct decision to go ahead and develop that thing. But once you invent it, you can't uninvent it. And there's just, I think the exact wording might be wrong here, was no choice but to build it and unleash it. Kind of like with the atomic bomb or with AI or with any major technological change, you just gotta kind of let it loose and kind of see what happens, and humans will adjust. But maybe humans won't adjust, I suppose, because the last thing that Warren said on AI was that AI can change everything except how men think and behave, and he was paraphrasing Einstein when he was saying that. So fair point in that AI ultimately is just a tool for humans, at least as of now, and maybe it might get more dire many years down the line, but we're not at that point yet. So for now, it's still just a supplemental tool. There will be disruption with any technology. And later on, actually in the Q&A, Warren Buffett was saying that the world is always changing and that opportunities come from, quote, other people doing dumb things, end quote. So that's where the opportunities lie. There's always disruption, there's always changes, but at least when it comes to investing, you're kind of taking advantage of other people's mistakes or other people's stupidity or other people's ignorance or whatever it is. That's typically where at least a company like Berkshire Hathaway can make a lot of money, is when they are prepared, because they know that things change. They know that things happen. And if other people got greedy or over leveraged or whatever, they would consider that doing a dumb thing, and they will capitalize on that. And it's worked very well for the many, many, many decades that they've been operating. Though, Charlie talking about the future again, and kind of the current investing climate, the economic climate, he had this kind of theme he was kind of pulling at in his throughout the Q&A sessions for, I mean, they probably answered about 6 hours of questions over 2 sessions. But he said that his advice to value investors would be to get used to making less due to diminishing opportunities and just the environment being tough to navigate. It's a very pessimistic note from Mr. Munger, but he kind of kept harping back to that, like, kind of harder times are coming, get used to less. Then that was kind of it. There wasn't a whole lot more to it. I guess it's always better to be a little pessimistic. You want to be optimistic in general, but not over-optimistic. That can get yourself hurt pretty bad. I don't think you want to be pessimistic to the point of taking an action, or to not taking action. But I think I can see where he's coming from. It's just don't get greedy. Just be patient. Look for the opportunities. There might be less. Better to be a bit conservative when it comes to that, anyways, to avoid taking too much risk. I guess I'll leave it there on that. Then a quick question on commercial real estate, because Charlie Munger recently said in the news that he thinks there will be a lot of damage in commercial real estate because of a bunch of bad loans. I probably say that about any time in the real estate cycle, but he says there will be a lot of hollowing out. Real estate is difficult. I like what we do better. That's what he was saying about real estate, and why is Berkshire going to try to get into real estate if there is a downturn, is I think what the main question was. And he was saying, no, not really. I did real estate long ago. It's tough, and this is better. It's kind of what he was saying. I didn't have too much more there. Warren Buffett chimed in and said that the price of real estate comes down to however much someone can borrow without putting their name to it, at least on the commercial side, because there's non-recourse debt, which is a fair point. That is, debt drives the entire real estate market. You could say it drives most of the financial markets in general, but definitely real estate, especially in the US, a lot of subsidized loans there. But the amount you can borrow without signing your name determines the price in general. So fair point, but that was pretty much all they had on real estate there. And when it came to I forget what the question was exactly, but there it was kind of along this theme of making money on people's mistakes or stupidity or whatever. And he said that Charlie Munger said, "I like my pile just the way it is." When he's talking about losing money, he'd rather not take excessive risks. He wants to keep what he has and defend that in a way while just growing it at a reasonable rate every year. But it's not like he needs any more money. It's kind of what he's getting at. So he's not going to do anything reckless, which is probably a good lesson for us all, whether you have a giant pile or not. Though it is kind of a sliding scale when it comes to what kind of risks you want to take depending on your goals. Warren Buffett said that he makes this complaint periodically about, I kind of mentioned it earlier, about having a big pile of money and then having to place that somewhere. It's very difficult because the universe of opportunities is lower, or there's just not as many deals that are great just because there's fewer. And he said that with a small amount of money, there's still plenty of room to outperform in a big way. It's kind of a counter to Charlie Munger's point about get used to less, and that the quote I have here from Warren Buffett is that the world is overwhelmingly short-term focused. Going back to this mistakes, stupidity, whatever it is, people doing dumb things. People are very short-term focused, and it's very hard to tell what's going to happen in the short term because the short term is really driven by emotions, mostly, and emotions change all the time. So it's very difficult trying to predict that. There's so many different push and pull factors, but in the long run, it seems that the fundamentals of a business, the performance of that business, tend to drive the investment price and the investment value. Though you can find some exceptions, but at least among a big sample, that tends to be what happens. At least that's what's happened in Berkshire's case. The businesses that do well tend to do better on the stock side of things or on the valuation side of things, and that helps their stock price and their business value as well over the long run. Though in the short term, lots can happen. And just kind of I don't know where to fit this in, but Buffett mentioned that the big money is in selling people ideas rather than implementing them for a lot of people, and a lot of people go that route. And you just have to kind of be careful there, especially when it comes to gurus and people trying to sell various courses on investing. A lot of the conversations I had with some people just during the whole weekend, we were kind of talking about that a lot of the creators in finance, both big and small, will sometimes tends toward that sort of guru focused business where it's about selling ideas, not so much actually implementing them. And it just creates some perverse incentives and something to watch out for. And it doesn't really just apply to investing, but applies to everything. But I'd say especially investing, because there's lots of people are trying to make money. And I forget where it was in the Q&A, but to that, Charlie Munger also complained about how everyone wants to be a wealth manager now. You have so much talent, so many smart people going to become wealth managers, and he sees that as a problem. I think that's a fair point. I think of that a lot when it comes to being an attorney and dealing with other attorneys, dealing with accountants, other professionals, dealing with tax professionals too. A lot of the system takes really a lot of what would be pretty solid intellectual talent. They take it out of, say, the hard sciences, out of inventing things, out of pushing businesses forward, and move them into really bureaucracy and dealing with regulations and dealing with the tax code. I just can't even think of how many millions of man hours are spent towards just preparing taxes every year. And it's not producing anything. It's just moving, pushing documents around and maintaining the existing tax system. And it's a real shame, but that's not the only place where you see that, and I definitely concurred with Munger there. But that's where the system kind of points a lot of people to. That a lot of people see the opportunity in being wealth managers and in running funds and just pooling money together, taking a fee on that. It's very lucrative, at least right now, just because that's where a lot of opportunity is, especially given increasing regulations, the difficulty of the business environment. A lot of people have turned towards the financial sector, which increasingly becomes bigger and bigger, and slice of a bigger slice of the overall economy and system. But it is an interesting observation. We'll kind of see what comes of it. Eventually, you'd think that the balance would shift back. You'd have a reaction back to maybe an overabundance of people in the trades if those become lucrative enough. People just go wherever they see the easiest way to make the most money in general, or given their skills. And right now there definitely is a tendency to move towards, we'll call it the white collar side of things, especially in the financial sector. we'll see what happens there. But back to the Q&A. They were asked about inheritance. The question went a little long. He never really got to his final question, but I think the general theme of his question was about if you have a business or a bunch of assets and you want to pass them on to your kids, how do you actually manage that? How do you teach the kids to take on the money or take on the business and that sort of thing? It was more about inheritance. I was very interested to hear what they would say about this. I don't know if I've heard much about inheritance from Buffett and Munger. I'm sure they've been asked before. I just maybe haven't heard it. But Buffett says that I don't sign a will without all beneficiaries reviewing it first. And that's an interesting point, that a lot of people seem to write a will and it's just kind of a mystery who's going to get what until the guy dies. And then the kids have to scramble and figure out what to do with the assets, the house, the business. And then a lot of times they just end up selling it because they weren't prepared to deal with it. Let alone not having the skills to do it, but they weren't even expecting to receive something or didn't know that they were going to receive something. So it does make sense to have any beneficiaries on the same page before that happens. But I wanted to see if he would talk more about just the incentives of kids knowing that they're going to get a bunch of money. It's something that I'm thinking about too, since I intend to have more assets than I do now by the time I'm older, and by the time my kids are getting older as well. I should have a good amount of assets if everything goes at least decently well, which there's a chance it doesn't, but if it does, I do want to figure out how I'm going to incentivize my kids to try and perform, and I don't want to just give them a giant lump sum if I have a giant lump sum to give. And certainly Warren Buffett has a giant lump sum to give, and that's a big reason he's given a bunch to charity when he dies. It's all been, a lot of it has been pledged to that. But it's a weird thing when just seeing some of the kids of great investors that were at the event. Not only do you have that financial issue of like, am I just going to get something for nothing? Effectively, you're getting a bunch of money from your parents that your parents earn, but you also have to deal with the reputation thing, and that's really out of your control. Where if you have a famous investor parent and you're the kid of that investor, even if like you're totally fine, totally competent, you're always going to have that sort of baggage of, oh, you're only here because your dad is this or your mom is this. It's just it's an interesting issue that it's very difficult to deal with because it's kind of a rare thing to be in. You don't have a lot of reference points for super rich people doing it. Anyways, I kind of wanted to see where he would go with that. He didn't really mention much about that kind of incentive structure. It was more just about being transparent, letting them know ahead of time, which is a fair point. Leaving your kids in the dark about what they will get or will not get, I think, is just a poor strategy. You should let them know, like, here's what we got. You're not going to get any of it, or you are going to get some of it. I think that's helpful for everyone. But you don't want to create that entitlement. And that's the hardest thing to shake with children, it seems, in a wealthy society where a lot of their basic needs are met. It's shaking the entitlement and trying to make them hungry for more. Without going insane, of course. Don't want to make them super greedy, but I think you know where I'm going with it. But yeah. But then Charlie kind of chimed in on that and said, you want to talk about, you just want them to hold. Yeah, I would give them Berkshire and just I think he said just hold the goddamn stock or something like that. Didn't go much into that. Buffett continued on that point. You really want to talk about values with your kids, and a cleverly drawn will won't substitute teaching them values. I'm paraphrasing a bit, but I think that's a pretty solid point, in that ultimately as a parent, your main focus should be to teach them values. I mean, provide them their basic needs and all that and put them in a safe place, but you do want to teach them values, and a lot of times you got to put them through some hardship, or at least less hardship than they would have if you gave them a big lump sum, I would think. So anyways, that was kind of that point. I would have liked that guy to finish his question, but he was kind of rambling, so they cut him off. But it was an interesting question, and I think the only one that kind of hit on that. Talked about how the U.S. is great, as they do. They don't want to bite the hand that feeds as well, so they tend to talk favorably about a lot of regulators as well when it comes to the central banks and all that. So can't be too surprised, since they're worth, the company's a few $100 billion, so it'd be a little odd to make themselves a target when asked tough questions about policy. So But just kind of one point on that. The question was like, what would make the U.S. strong or make it weak? And he says that the government is always a bit of a mess, and there are always problems, but somehow we make it through. You mentioned that the U.S. has been through a civil war. It made it through that. It's like, okay, sure, people can get through hardship, but you'd like to avoid problems if you can. And this is where Charlie chimed in again with that theme. The best road ahead to human happiness is to expect less. So, all right, I guess don't feel like you're entitled to more. Just expect less. It's probably a good rule to live by in any environment. Just expect less, and then when you get more, great, you'll feel better about it. So, someone asked regarding inheritance and who's getting what. Someone asked about the threat of a corporate raider after death. And so, for example, they said Buffett's pledging all of his stuff to foundations. After the foundations spend all that money to use towards their causes or sell the shares or whatever, you'd have a lot of shares out there effectively. And could a corporate raider come in and get in? But Buffett's answer to that was they're probably too big for that, and they'll try to lean on the positive record of Berkshire to kind of dissuade something like that. Corporate raiders usually come in when there's some sort of issue or thing that they can tap into, but Berkshire's such a powerhouse, it'd be kind of weird. First off, you'd have to pool enough money together, which seems very unlikely, but then you'd actually have to liquidate it, which why would you want to? I guess to pull the cash out, but it's running great, so it'd be kind of odd to just do a raid on that. But anyways, that was that quick question. I guess his final point there was, we'll win out if we deserve to win out. Fair enough. If it's not worth liquidating, then why would someone liquidate? So moving on to the rest. I forget what the question was here, but Buffett said that the secret to business is to buy a good business. I believe he was paraphrasing Greg Abel. I'm not sure if it was him or not. He said, but I forget what he said. But there's really a lot to that. It sounds so simple, but if you can find a good business, the business itself, if it's run well, that's going to do most of your compounding for you, even if you don't necessarily get a great deal on the initial purchase. If you can find a great business, that can right a lot of wrongs. But the hard part is to find a good business, and you can't pay any price for a business, even if it's great. But as long as it's kind of within that range, that fixes a lot of issues. Is even if you get a supposedly great price on something, at least based on its asset values, if that business runs the assets into the ground, then okay, who cares how cheap you got it a couple of years ago if it's now worth zero? So, secret to business is to buy a good business, according to Warren Buffett. Sure. They were asked about banks. I think this started the second half of the Q&A, and fear is contagious in banking, says Warren Buffett. He did mention about First Republic, which recently went under, is going through a restructure, I guess you could say. He said you could see their mortgage and loan portfolio was out of whack, and it was in plain sight, and the world just ignored it. Paraphrasing again, but it was all there. You could see the portfolio. I did a video some time ago about Silicon Valley Bank, and if you looked at their balance sheet, it was there. Not super obvious, but if you did a little bit of looking, it's all public. You can see that their portfolio was worth a lot less than it was on their balance sheet. And you can say that about a lot of banks. And yet, it wasn't a problem until 1 week when everyone decided to make it a problem. But it had been a problem for a long time otherwise. And that was Buffett's main kind of complaint, just like it's all out there. And maybe back to that theme of, yeah, you make money on people making mistakes or on people making dumb mistakes. People ignored that First Republic had these problems and other banks had these problems, and now they're paying the price for it. Yeah, hiding in plain sight. The world just ignored it. And you probably say that about a lot of things when it comes to investing. They were talking about, I think the question was about inflation. Charlie Munger said, at some point, printing money to buy votes will be unproductive. Of course, he says, don't try to imitate Japan, because they pretty much invented quantitative easing. I guess in the modern era, they did not invent money printing, that's for sure. But the way they're doing it and purchasing bonds and assets, they kind of were pioneers in this modern age of monetary policy. Don't try to imitate them, because they've had just a very poor, all the incentives are out of whack. When you print a bunch of money, no one wants to necessarily hold the currency as much because that's going away, or that's being whittled down by all the printing, and then you're propping up things that maybe shouldn't be propped up. But anyways, he says at some point that will be unproductive. I think that's a fair take. We've seen that many times through history. Printing money to buy votes is very harmful. And Buffett kind of responded to that with, I really liked this point, but the best defense to inflation is your own earning power. You'll succeed by your talents. So if you can make yourself more valuable, if you can find a way to make more money, you don't really have to worry about inflation because you're valuable. And your value will go up and down in nominal terms, depending on whatever the currency you're selling your value in. So as long as you're more valuable and you can provide a service, provide a skill, provide knowledge, whatever it is, you're gonna be fine through inflation. And if you can't, well, you're not gonna be fine in pretty much any environment. You have to provide value, and the goal is to try and provide more value as time goes along. So that's really your ultimate defense to really any economic hardship, is being able to provide value to others and expanding your skills and working on that sort of thing. So that was a really good point from Warren Buffett. Talking about life values, Buffett said that you want to write your obituary and work backwards from it to kind of get where you want to go. He's mentioned that concept a couple of times, just working backwards, right? But he mentioned write your obituary, and what do you want people to say about you if you're worried about that sort of thing? Might as well write it out, and then, okay, there's your goal. How do you get to it? It's a some good life advice, even if it sounds simple or it sounds maybe a bit morbid, but it makes sense. If you have an idea where you want to go, best to conceptualize it and then go for it. And they were kind of on a life advice sort of tilt for the second half. Maybe it was just the questions they were getting, but Warren Buffett was quoting Tom Murphy. You can always tell someone to go to hell tomorrow. So just trying to live a kind, live with kindness, trying not to be mean or degrading to people. It doesn't really help you in any way. And when you can be nice to someone, or at least be calm in the face of adversity, then you'll succeed a lot more than somebody who can't stay calm or gets angry or whatever. Not that you have to be completely stoic necessarily, but I think you know where I'm going. And he also said to that, I've never known anyone who was basically kind who died without friends. So just being kind and you'll have friends, because people hang out with kind people at least much longer than they'll hang out with people who are mean. So be kind, be calm, and that should get you a pretty long way in the game of life. So some timeless wisdom from Warren Buffett there. And then I think this was on the same question, but Charlie Munger said, you want to be able to succeed without the need for luck. So you don't want to go for these kind of YOLO bets, or at least you don't want to rely on them. You really want to go for something that's a lot more certain. And this might go back to kind of Warren Buffett talking about creating value and building up your skills and kind of working on those more certain things. You know that you can provide value and you know you can improve yourself. So working on that makes a lot of sense. But you don't want to rely so much on luck. Yes, there's a luck element to pretty much everything, but you do want to try and go for those things that you can influence, or at least you have some sort of certainty in, some sort of confidence in. Makes a lot of sense. This is an unrelated note, but they were asked about the energy industry, and I think they were asked about like renewable energy and clean energy and what Berkshire was doing about that, because they have a massive energy arm of their business. And Charlie Munger said there's a lot of nonsense in this industry. There's a lot of nonsense in this industry. If you like nonsense, then this is the industry for you. So regarding the energy industry, thought that was just a funny one. But there is a lot of nonsense because you hear about the politics of energy and various policies, and it gets kind of exhausting sometimes. And they're dealing with it every day. Yet they manage to make it work. But you just have to kind of get through the noise, especially in the energy front of things, and work through the policies when you have to, work through the regulations, but it's a tough space, as they say. Though it's funny because right after that, Munger said that Warren and I look for the easy job. We don't want that much failure. They were asked about Elon Musk and overestimating himself. And he's like, yeah, he does overestimate himself, but I don't want, but that's what he likes to do. He's an entrepreneur. He takes the risks, and and then Warren and him would rather look for the easy job. They'd rather look for the thing that is in their wheelhouse, doesn't need a lot of things to happen, back to that luck point. You'd rather go for those things that are more certain, that they can understand, and they know that this should work decently well most of the time. Whereas with Elon Musk, and other entrepreneurs as well, a lot of them are going for totally pioneering certain industries, creating industries practically, and there's just a lot of risk there. You never know what you're going to run into, and it's a very different game. It's not that it's not a very valuable game or that you can't make a lot of money with it, but it's just not a game that they want to play. And Warren Buffett said, you need fanaticism, and I like the way I'm living. So he's not into that sort of a more speculative, super innovative, inventing things. There's just a lot of things to get through there that are a lot more difficult, and it's a totally different game to play. They were asked about buybacks again. I kind of mentioned that already. Rehashing on that sort of, we always prefer to buy businesses, and having the cash available lets us do deals in tough times. He mentioned Harley Davidson and Tiffany's in 2008, among others. Something like that will happen again eventually, says Buffett. And buybacks would just be a second choice if Berkshire's trading well into their kind of price target, but otherwise they would much prefer to buy businesses, and they want to have that cash available, so if there is tough times, they can take big swings on big discounts for things and really succeed that way, as they have many times before. And I just found that point funny, that not funny, but he was very clear in saying that something like 2008 will happen again eventually. So even into his 90s, or both of them into their 90s, they know that they've seen this before. They've seen plenty of crashes before. They know they happen. They know it'll happen again. That's just how this goes. So you want to be ready for those crashes, especially in their position where they have so much at stake. My favorite line of the entire Q&A session was an attorney asked Charlie Munger a question about just basically advice for attorneys, like, for career advice. And he didn't have much to offer other than he said he heard from, I think he said his son-in-law or daughter-in-law, that talking about the modern big law practice, someone who came from it resonated with me, but he said, it's like a pie eating contest where the winner gets to eat more pie. that was the best line. That one got everyone laughing. And a lot of things that Charlie said got people laughing, but I have to say that's quite accurate. And you could probably say that about a lot of, especially big corporate jobs, where you do a great job, and your reward for doing the great job is you get more work, and if you don't do a great job, you don't meet your hours or whatever it is, you lose the job, and the other person will get all your hours. So yeah, go eat some more pie, I guess. This was an interesting answer to what I thought would have led to a different answer, to a question I thought would have led to a different answer. But he was asked what the hardest part of the job was. So they both were. And Warren Buffett said that there is no hardest part. He knows what will happen each day. He loves the people he works with. He has the ideal working conditions. He can't imagine anything better. Though, on top of that, he said, part of the fun of golf is not getting a hole-in-one each time. And he likes some of the working on those challenges. You never really know what's going to happen. You don't want things to be perfect every day. You like working through the adversity. And I just found it funny that he said there is no hardest part, because he loves what he's doing. And sometimes when I hear that from CEOs, I always think like, they're just saying that because they don't want to make anyone upset. But he is living by it. He's in his 90s and has no reason that he has to do this. He can do whatever he wants, but he chooses to do this. Maybe it's all he knows, but he is choosing to do it, so he must like it in some capacity. So I would tend to believe him there, that he really does love what he does, especially seeing how he lives his life compared to other billionaires. I went by his house here in Omaha. It's a nice house, but it's not what you would picture a billionaire's house being. It's the same one he's had for a very, very, very long time. He's working at the same company he's worked at for a very, very, very long time. He just clearly likes his routine, which is great. Well, another thing he said there is, we get to forge our own destiny and follow our principles, and he loves that. That kind of goes maybe back to entrepreneurism and running your own business. The freedom is very much an asset, even if it doesn't show up on the balance sheet. Definitely shows up on the emotional side of things, in that you have that freedom. And if you're wired that way to like that, then it's great, because you can really do whatever you want within reason, but compared to someone maybe who's working for someone else. You're told what to do, and some people would prefer that. They don't like having to work through trying to structure a day from nothing. It can be quite difficult. I'm kind of going through that now with building my own business and now building my own law firm. You have a lot of options. It's kind of overwhelming at times, and when you're just told what to do, it's pretty easy. Well, it's comparatively easy as long as you're okay with that. And not everyone's okay with that. Not everyone's okay with the other. So however you're wired is kind of what that comes down to. And talking about kind of delegating managers, Buffett said that he wants managers who love their business, but not what comes with it. When he's looking kind of for those, I don't want to say mid-tier deals, but when he's looking for smaller deals by Berkshire standards, he wants those businesses that where he can place the manager there, but it's a manager who helped build that business, but just doesn't want to deal with the back end. They don't want to deal with raising money, finding financing, dealing with policies. They just want to run the business. They want to run the team, and that's what they really like doing. So he really looks for that in his, call it his partners, the people where he buys the business and keeps them in place. And they try to provide that freedom from certain burdens. So sure, they're giving up equity, but they're fine giving up the equity. They get a nice payout, and then they get to work on the stuff that they like working on anyways. And I thought that was interesting that it's, even though they're technically not incentivized exactly like an owner anymore, but if they like what they're doing, and who cares? They got their payout, they got their money, and now they get to do what they want to do. And I'm sure they're still aligned with certain payouts and holding on to some equity. But it was an interesting point there on how they kind of delegate things. A couple more things. This was a weird question about spending on private jets, talking about net jets. I don't know what to make of this point. I don't know if Buffett meant it to come out this way, but he said on spending on himself, he was kind of like fumbling his words when talking about spending on luxuries, because compared to other billionaires, he doesn't spend a whole lot, and definitely not a lot relative to his net worth. So, but he says he does use NetJets, which is like a private jet service where you rent out hours, and it's expensive, but relative to actually owning a private jet directly. But anyways, he kind of talked about how every dollar he spends is one less dollar for your heirs, your beneficiaries, or in his case, foundations who are receiving his Berkshire stock at the end, or all of his assets at the end. And he says that basically the money he spends on himself just has to be better than the last dollar that the foundations who would otherwise get them would spend it, which is a bit weird. In that he's like, well, I'd rather spend the money on the jet than give it to some foundation that might waste it. It's kind of what it sounded like. I don't know if that's what he meant to say, but it did come off that way. We were 6 hours into questions at that point, I think. So, but it is true that every dollar you spend in your life is dollars that can't be spent by your beneficiaries in their life, or after your life, I suppose. So interesting point, but he was trying to justify the jet spending. It's kind of funny. And then Charlie Munger said that he historically has liked flying coach, and he said that one big reason he liked flying coach is because when he'd go to the back, like everyone would cheer for him for coming back there. So he was very very unashamed about that point, which I thought was quite funny. It's just a funny side point from Warren Buffett. He said he recently read the 1932 GM annual report, and talking about like auto dealers, auto manufacturers. It wasn't the main point, but he said that he recently read the 1932 GM annual report, like in the last month or two or something, like recently, like from 1932. Like, this guy just loves reading and loves looking at history, loves reading about business, reading about companies, to where he's going all the way back to the 30s and just reading about auto manufacturers at that point, auto dealers then. Just a easy point to overlook, but he's deep into it, so he likes what he does. He must like what he does. He's going all the way back there, just kind of casually. And last point that I have written down here from the Q&A was from Charlie Munger on passing down wisdom, back to this inheritance point, I suppose. He says, my kids can follow me, grandkids can follow me or not, even if I don't like what they're doing. it's really up to them. He's not going to try to force them to do anything, even if he might not like it, even if he might try to convince them otherwise. It's really just about living the life that you want to live, and they can follow him or not. It's their choice, but ideally you can set up the value system enough that they're able to learn from your experiences. But if they don't want to go down your path, that's okay. Okay, so those are my notes from the Berkshire Q&A session. Very informative and just great event. Just met a lot of great people here, and I'm looking forward to doing it again in the coming years, and definitely doing another punch card meetup, because that was great. Got to meet a lot of people who've been watching both my content and other people's content in the punch card group. So really, really great just to meet all these people, and a lot of like-minded folks naturally. A lot of people focus on the long term, focus on patience, focus on education. So it was just really great, and just a good group to be around, a good group to learn a lot of things from. So, and that's before we even talk about learning from Warren and Charlie themselves and what they've been doing for so many years now. Otherwise, thanks for watching, everyone, and definitely let me know what your thoughts were on the event, if you've watched the whole Q&A session, or anything else you might have learned from the Berkshire weekend if you were there, or if you weren't, or whatever you learned from this past Berkshire event. Definitely let me know in the comments below, and be sure to subscribe so you don't miss future videos. Otherwise, thanks for watching.